Hey, welcome back. Many of you suggest a variety of companies to look into, and if I cover them one by one every week, I'd never be able to catch up. Instead, I decided to make it into a series where we look at 4 or 5 per video together. If there is something that many of us like, I can then do a deeper analysis like the usual. To begin with BHP, which I covered before, they are a top 3 iron producer with operations in the Americas and Australia. They can make around 6, 13 and 25 billion per year depending on commodity prices. For a 140 billion market cap, that's around 11 times the average. The current assets cover the current liabilities, and overall the total assets are well above the liabilities. So not bad for a mining company. However, we see a very significant chunk of them being in provisions, but more on that in a bit. The dividend policy gets you at least half of the profit, so you can enjoy the good times. We see pretty significant dividends in the past, especially if you bought during the downside, which is ideal for a commodity company. Comparing it to a company that's forcing itself to pay or even increase a dividend no matter what, this is ideal. Lately, they've been divesting the coal assets and focusing on copper, nickel, potash and more, like a majority of the big mining companies. I think this reorientation is good, but they have to be careful with how much they pay for it. If they rush this too much, they can dilute or issue a lot of debt for a 3, 4, 5% return, which is terrible. And we know that mining companies often overpay, especially if they buy during the upcycle. They talk about these megatrends that should benefit their portfolio. You have the traditional demand and stuff like competitive advantages, supply headwinds, as well as decarbonization. This one seems to be the main focus of the investments, which I don't think is a bad idea. They recently had a 39 billion bid for Anglo American, which they refused, trying to rapidly expand the exposure to copper, nickel and platinum. Copper and nickel are vital for EVs, while platinum is basically a hedge in case the adoption is slow. I have a video about such a miner in case you're interested. They might offer more in the near future or buy only some assets, so it's probably not over yet. I think we'll see more transactions like this, especially from the big mining companies like BHP, Glencore, Rio Tinto and so on. The more they wait and see how the demand for copper, for example, develops, the higher the price they'll have to pay, so I think that's why they focus on this kind of deals now. They also invested a lot into potash used in fertilizers, and when that becomes operational, they'll be one of the biggest players on the market. And having it produced in Canada is very important for strategic reasons. So they are focusing on quite a few trends with different growth potentials. Copper and nickel should be the higher growth ones, while potash, iron and the rest should offer more long-term stability no matter what, since they are vital. Thanks to this focus on acquisitions from bigger companies, I tend to prefer the smaller ones that can be the targets, but they also have potential. Now, there is also a significant risk to keep in mind with any mining company. No matter where and how careful they are, accidents can happen literally overnight and they can have terrible consequences. There was such an accident in Brazil about a decade ago, and BHP, together with Valley but also alone, faces a couple of massive lawsuits. We can't know how much and when or if they will have to pay, but it's a significant risk to keep in mind. That's why they have 19 billion in provisions, which is very significant. And very recently, Brazil rejected the settlement they proposed. I keep saying this, but anything related to mining iron or copper will depend on China. The country represents a majority of the demand, so any producer is technically also a bet on China. It's not necessarily bad, but you have to keep them in mind. Now, given the risk, I'd maybe pay around 5 times the average cash flow, so a market cap of around 65 billion. That's a price of around 25.6, which is very low for them, but it would unlock very attractive dividends. Now, Snowflake, this is one of the largest software IPOs in history. They are a cloud-based data warehousing company facilitating the storage, managing and analyzing of large amounts of data. They work with a bunch of very big companies, and what they provide is useful in quite a few industries. When you think about machine learning, data science and analytics and stuff like that, that's what you need them for. Now, this kind of service should be requested more and more in the future. Maybe we don't see it, but this becomes essential behind the scenes. They have 5 billion in current assets, which is enough to cover all the liabilities, most of them being in deferred revenue. With about 5.2 billion in equity, or 4.2 without the goodwill, the market cap is nowhere near that much, but this is a tech company, so don't expect a lot of equity. They are still developing, but currently they can make less than $1 billion, so the market is very optimistic about their growth. If they quadruple the cash flow, this may be a fair price. Still, on a net income level, they are bleeding more and more money. To fund all the growth, they seem to issue stocks, which can be a bit of an issue if the price continues to fall. Anyway, the financials currently allow them to also get into debt, but this is a relatively new kind of business. We don't know if they can actually be profitable, and even if they become, will it be a 50% margin or 25%, especially if there is more competition. They expect the operating margin to be 6% this year, so that's a bit of an issue. Imagine if a company like Alphabet focuses on this market and acquires a competitor, for example. Will this be 2-3%? We see revenue growth in the 30s and also a higher number of customers, but that wasn't enough for the market. And that's a risk to keep in mind. Yes, they can grow, they basically tripled the revenue in 3 years, but will it be enough for the market, especially when the valuation is so high? They recently announced a new AI model competing with OpenAI, Google and so on. The stock benefited a bit from the AI hype, but then crashed significantly due to the earnings. They also announced that the CEO will leave the company, and I want to point out that he actually lied a few months ago when asked about this. And he got paid very well for the lie. He became CEO in 2019, took it public in 2020, and 4 years later he retired with a net worth of like $4 billion. I couldn't find if the shares he got were restricted for that time, but it's definitely interesting. I'm not saying he did something illegal, but I think this kind of person should have a bit more accountability. Now back to the AI, there is untapped potential, especially if they integrate it with the other services that they offer. This could help them grow even more than expected, so we'll see in the next reports. But think how much they have to grow so that the current price is relatively fair. They would have to at least triple the revenue again and improve either the margin or the cash flow conversion rate, which isn't easy. Even then, that's basically a fair value, and what happens after it? Yes, the market has potential, but what if that attracts even more competition? So this will depend on if and when they can make money, and of course, how much. I'd say this is a high risk, high reward investment. It doesn't mean it's bad, it's just not something I would go into. I can see the potential and how important this industry is, but first I want to see something quantifiable. Now, CVS, this is a leading healthcare company that's currently close to a decade low, paying a pretty attractive 4.75% dividend. They are probably known the most for their pharmacies, but they provide other health services as well. Overall, the 3 branches of the business are pretty much equal. They can make around 13 billion per year, although they started to show some weakness recently and see about 7.5 to 8 billion this year. For a 70 billion market cap, that's a ratio of around 9, which is generally low but actually high for CVS. We can see a very rich history of acquisitions, including a few recent ones, and for CVS this is basically part of the business model. That's how they grew and developed into a $70 billion company. Due to the very high competition and disruptions like Amazon, they seem to be focused on branching out into other healthcare sectors, which isn't a bad idea. But this has an effect on the number of shares and the balance sheet. We can see a constant increase and decrease depending on what they buy and the buybacks. They have current assets of 67.5 billion, which aren't enough to cover the current liabilities, but with the cash flow and maybe some revolving credit, they should be fine. However, the bigger issue is that they don't really have that many non-current assets. Yes, you see 74 billion in equity, which is above the market cap, but that's all in goodwill. Now, the goodwill is a result of all the acquisitions. Again, it's basically part of the business model, but it's still a lot. In a way, you can see it as a lasting testament of how much they overpaid in the past. The idea is that you overpay, but you make it out in long-term synergies, so it's not that simple. Still, you can sell it if needed, and it has no real value. Something very important with this kind of investment is the sustainability of the dividend. We saw the impact of a dividend cut to such a dividend stock with Leggett & Platt very recently, and that's something very unpleasant that we really have to be ready for. This is unfortunately a very low margin and competitive industry, and any disruption like Amazon can be enough to make the dividend unsustainable. As a retailer, you really don't have that many advantages and tools to fight off the competition other than the price. So even if they recover, don't expect some huge growth in profit. The only way they can deliver some growth might be if they go into other branches like they actually do. So if they can make around 13 billion, discount around 2.5 billion for the interest, 3.3 for the dividend, around 3.5 on average for the debt and 3 for the buybacks, and that's actually not bad. If anything, they can adjust the buybacks or refinance and have enough flexibility. However, they don't expect to make 13 billion. Based on their expectations, they should make around 7.5 to 8 billion instead, which could be a bit of an issue. So they might have to cut something or issue even more debt. I'd say we shouldn't see a dividend cut, which is pretty attractive now that they pay so much, but it's kind of close. A few more years like this might make it a reality, but on the other hand, they do so many acquisitions that they might successfully develop out of it. So this is kind of uncertain and it's ultimately going to affect the valuation a lot. If they get back to 13 billion for a relatively high ratio of 10, that's a market cap of 130 billion, meaning a price of 103.6. That's very similar to the high from 2 years ago. So that's close to a 2x plus locking in that nice dividend. If they don't and cut the dividend in half to make it more sustainable, then they'd probably keep crashing to like 4 times the cash flow. If they make 8 billion, that's a market cap of 32 billion, meaning a price of 25.5, so pretty much a 50-60% loss. You can see how big the difference would be. Overall, not the best financial health and the industry is very competitive. Sure, they could be the best company in their market, but I really don't like the industry. Any disruption can instantly turn a profit into a loss. At the current price, I'd say this is a medium reward, although it got better, for a medium to high risk, so not really a screaming buy for me. Maybe if the potential was double that much or the dividend was 6-7%, then sure, but this level of risk for this potential isn't that good in the current market. You know, 3-4 years ago, yes, it would have been relatively attractive, but in this market there are so many better options. Now, Ternium, this is a leading steel manufacturing company in Mexico and South America with quite a few very important advantages. They can make around $1 billion depending on the market, which is very good for an 8 billion market cap, but that's above the average for Ternium. Now, obviously, even if they wouldn't sell anything there, they would depend a lot on China. The country makes the price due to the supply and demand they provide in the market. But at the end of the day, these are very basic products and the competition is massive even if you don't count the Chinese companies. Ultimately, other than the price, they don't have that many tools to fight it, so don't expect some huge margin from such a company. Still, they offer fundamental products for our society, so they can still have a place in the market. However, there is another competitive advantage that allowed them to develop so much. They produce and sell it in Mexico and South America, so they also depend a lot on the development of the region. No matter how cheap the steel is, shipping it from China is a huge cost and can take a lot of time. They also have companies like Valley mining the iron pretty much locally, so the production cost wouldn't be high. So they have a massive advantage and are likely to keep being a leading company in the region. Competing with them as an outsider is actually very tough. Now, they have really good financials, with the current assets almost doubling the total liabilities, so they shouldn't have any kind of financial issue. Also, the equity is about twice the market cap, so they are traded at a very attractive book value, which is kind of common with companies in the region. But keep in mind that there is political risk. It's been okay so far, but it doesn't mean that it can't change. And keep in mind that 75% of them is owned by the company that owns a bunch of this type of companies. If they want to sell it or buy you out at a loss, they can do it. That's why buying at a good price is even more important with this one. It's unlikely, but it's something to keep in mind. On the bright side, this can be very volatile due to the low volume, which can open opportunities. As you can imagine, when they make $1 billion and the market cap is 8 and they don't have a lot of debt, they can easily pay a massive dividend. Last year was actually a record, but don't expect that every year because this is a cyclical company. But even if it's relatively cheap, I think this is a high price for Ternium. We can see very well how they depend on the economy and the price of iron, and right now the market seems disconnected from reality and stuck 2 years ago. I'd buy it like 20, potentially getting some 20-30% dividends in good times. Overall, definitely an interesting and very financially healthy play if you want exposure to the development of Central and South America. It's been on my watch list since 4 or 5 years ago. Now, Lululemon, they are a pretty big brand of clothing and shoes similar to Nike. The market cap is around 45 billion, while they can make around 1.5 billion during an investment cycle, so a ratio of around 30. They reported a very nice increase in revenue and profit, as well as a huge increase in international revenues. This has to do with a plan that they have, but more on that in a second. They also have a very attractive margin. They don't pay a dividend, but they do buybacks, which isn't really the best time to do that. There is a lot of room to grow, with the Americas representing 80% of the revenues. Despite doubling since 2021, China and the rest of the world are still very tiny in comparison. Just the expansion can offer a huge amount of growth, so that's very promising. They have a plan where they focus on products and the expansion, and we can see that in the significant international growth as well as the increase in the number of stores. I believe this is the right thing to do right now, and it can offer a lot of potential. Financially, they are in a very good position, with the current assets well above the total liabilities, and overall a lot of assets with very little goodwill. So I don't think there is anything to worry about from this point of view, but the book value is a tenth of the market cap, and even if you include the theoretical value of the brand, it's probably still below that. Looking at Nike for comparison, we see very good financials, but an already established global presence. They can still develop, but the mix is a bit more diversified, meaning that they have a deeper presence in Europe, China and so on. Now, Nike is about 3-4 times bigger and can produce 3-4 times more than Lululemon, so you can say that they are kind of a mini Nike that has more potential to grow. On the other hand, Nike offers a more reliable cash flow and a much more powerful brand. So each of them has its own risk and reward. If they continue, I think this can easily double. If they reach a cash flow of 3 billion and the ratio remains the same, that's basically it, so it's not something too optimistic. You know, they have a powerful brand, very good financials and potential to grow, but 40-50 billion is a bit much for me. It's kind of a fair value if you account for the growth, but I want to get it below that. Maybe something around 200 per share would be my target. Still, not a bad company, and it has potential, especially if they expand internationally. I'd say they are kind of similar to Starbucks, but with better financials and more potential to grow. If I manage to buy them at that price, this can even be a 3-4x. So that's it for today, and let me know if you agree, disagree or have other ideas. I'm trying to keep the videos below 20 minutes because it takes forever to research, record and edit them. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.